Welcome to another video of financial indicators. Today we'll be talking about video number 3, which is related to the GDP, annual growth rate. GDP stands for gross domestic product. So let's first define this subject, what it is that GDP means, the growth rate for it, what it does. Actually, it measures how much a country economy has expanded or contracted in a given year. It compares to that year to the previous year. It reflects the value of all goods and services produced within a country borders over specific time. Investors usually use this, to look at the GDP growth to assess potential returns in stock markets, of course, and company performance, and how the company perform better in a growing economy, and making their stocks more attractive. And that's the subject we'll be addressing today. So usually there are what they call them the impact on major decision makers. Who's those decision makers in this subject, the gross domestic products? First would be, of course, the government. And that means the government policy. Strong growth allows government to invest in public infrastructure and reduce taxes, which is very good, or implement social program. In contrast, slow or negative growth may lead the government to the policy of austerity measures or increased borrowing through issuing more bonds to investors, and that put the government into a deep debt. Okay, who's the other decision makers? Banks. Banks, especially commercial banks, adjust their lending rates in response to changes in central bank policy, which is influenced by GDP growth rate. For example, if a growth rate slows, banks may offer lower interest rate to encourage borrowing, because they want the people to grease up the market and start moving things upward. Of course, people need money, so they lower the interest rate for that purpose. So those are the major decision makers that affect the gross domestic products, annual growth rate. So now let's address it, how the effect of that GDP will be on general aspect of economy for its levels, if it's been low or it's been high. So now we'll address the low rate. Let's go for the market confidence. What will happen to it? Low or negative rate often causes uncertainty and market volatility, which negatively affect, of course, the market, and that will make the market confidence goes down. How about government debt? In terms of a slow growth, government may need to borrow more funds. Through what? Through loans to cover up its operation, leading of course to higher interest rate, because the more they borrow, the more the banks will start charging more interest rate, and that will make the debt of the government goes higher. How about the interest rate? If growth is slow or negative, what's going to happen? Federal Reserve may lower interest rate to allow borrowing and stimulate the economy. They want the economy to be greased up, and the money is the grease for the economy. So interest rate will go down. How about the corporate earning? What's going to happen to it? With the low GDP growth rate, usually means less consumer spending and demands for goods and services, which will dampen corporate earning and its stock market. So corporate earning will go down. How about the bonds then? Okay, of course, interest rate will fall due to that, because remember, we need to lower the interest rate to grease up the economy, so the interest rate will fall, and that makes bond what? More attractive as a saver investment for long terms. Bond will be in a higher demand, so the bond will go up in prices. Okay, how about the stock? What's going to happen to it? Okay, its price of course will drop, because as low GDP means companies' revenue are less. When a weak GDP data is published, it could lead investors to panic and start a sell-off, so the stock price will go down. How about currency? What's going to happen to it? Okay, a weak GDP growth can lead to a currency depreciation as less investors shy away, so the currency will go down. So now let's address how the effect will be when we have a high GDP. When we have a high GDP, what's going to be the effect on the market confidence? Okay, so a high GDP signals a strong economy and attract investors, and it boosts stock market, so the confidence will go up. How about the corporate earning? The corporate earning, with a higher GDP growth rate usually means more consumers spending and high demand for goods and services. As we said, higher GDP growth rate usually means more consumer spending and higher demand for goods and services, which of course boosts corporate earning and stock prices, so corporate earning will go up. How about the bonds? What's going to happen to it? If the GDP is high, if the economic growth, interest rate might rise with that, which makes existing bond, with the lower yield less attractive, causing bond prices to fall, because you are issuing now new bonds with newer interest rate and higher, so the bond will go down. How about stock market? What's going to happen to it? Of course, a rise, in response to strong GDP growth, as companies of course will expect, will be higher revenue and growth, so the stock market will go definitely up. How about the currency value? What's going to happen to it? Of course, a growth can boost a country currency as it signals robust economy, attract foreign investor, and the currency will go up. How about interest rate? What's going to happen to it? Of course, if a growth is too fast, Federal Reserve will interfere and may raise if the growth is too fast, Federal Reserve may interfere to raise interest rate. Why? To control inflation from happening, because if people start buying and prices start going up like crazy, you're gonna really have inflation, and that's another issue. What about the government debt? What's gonna happen to it? Of course, when GDP growth is high, government collect more taxes from income and sales, making it easier, of course, make it easier to manage its own debt, and the government debt will go eventually down. So this is the two aspects, between the low and the high, and this is here an overview. You can see it side by side for your own comparison. So this is just a chart here to show you the combined effect of GDP growth, interest rate, stock market, and bond prices. You can see from this line here represent the bond prices, okay, and this line here, the bottom one, represent the interest rate, okay, and this one here is the GDP growth rate, okay. You can see, and the green one of course is the stock. See, as the GDP goes low, here, and then it goes high again, see the stock, it's almost resemble what's going on. Going down GDP, stock price is going down. Going up, stock price is going up. Okay, so the GDP effect has a high actually effect on the stock index. So I hope this video was very beneficial for you, and I see you in the next video.